Welcome to the Honest Money Show. A big thanks to our sponsor, Shop Bitcoin Australia, for making today's episode possible. Hello, joining me today is Paul Musson. Paul is a veteran investment professional with over 30 years of experience in traditional finance. He brings an insider's perspective on flaws of traditional finance, you could say, and he's also the founder of Paddington Capital Management, which focuses on investment consulting and financial reform. While his blog, Political Economy, spelt Paul for Political Economy, dissects economic policies and inequality in an accessible, no-nonsense terms. Most notably, his book, Capital Offence, Why Some Benefit at Your Expense, is out now, and we're here to talk about that. Welcome to Honest Money, Paul.
Thank you, Anja. It's great to be here.
I would love for you to introduce yourself as well to my audience a little bit and, tell us what your journey has been to this date and what ultimately led to you writing this book.
Okay, yeah. So I was going way back. I was born in Wales. The family moved to Montreal in Canada in 1965. I was almost 4. Grew up there. And but I wasn't fluently bilingual. It's a bilingual province in Quebec, French and English. And language is not my forte, even English, never mind other languages, So it was tough finding a job. So in 1990, I loaded up my 1980 Plymouth Volare with all my possessions and headed to Toronto looking for work. And so I arrived in the city. I was literally sleeping on a hardwood floor of like a small bachelor apartment. I don't know what you call it in Australia, but it's like a one room plus a bathroom. Just started looking for work, and my first job was in a video store working nights from 6 till 12:30 at night. And I was 29 years old. And that's how I got my start in Toronto. And it was a long, sort of circuitous, uncharted path, if you will, to get to where I got to. I knew I wanted to be in research. I knew I wanted to analyze businesses, investment analysis, but I was very naive about the structure of the industry because all through school I wasn't really serious about. I knew school was important, but I didn't know what I wanted to do. And so at the time, all I wanted to do, I had a thirst for knowledge. So history or philosophy, geography, nature. So I would just do what was required in school just to get by, rush home and read my books. And it reminds me of that old Mark Twain line, I never let school interfere with my education. And so I didn't realize at the time, but I was sort of building a foundation of principles and morals, I think, at the time. I was just doing it because I loved it. It was so much fun. And then, one job led to another. And eventually, I ended up in the mutual fund industry. Started as an analyst, then I became a portfolio manager. And then my boss left. And then I ended up heading up the team. And our investment style was to invest in very high quality companies. Defined as a business that we think has a sustainable competitive advantage. It's not that difficult to find businesses that have a competitive advantage. You can just look at the financials, and if you've got great cash flow, great free cash flow, good return on capital, they're growing, they have a strong balance sheet. You might not know what's special about them, but there's something special about it. Then you got to go figure out what it is. What is it that enables that company to generate these great financials? You can figure that out. The most difficult part, of course, is having confidence with respect to the sustainability of that competitive edge. And there are no guarantees, but one of the big things that we would look at is the corporate culture of the business. Is it a self-reinforcing type corporate culture? Is it a business model where all the constituents of the business are benefiting? So not just the shareholders, and senior management, but also the suppliers, also the employees, also society at large. And then finally, the sixth one, and the most important, the customer. Is it a true customer value proposition that the customer is willing to pay for, part with some of their hard-earned capital to buy whatever it is you're offering? And the reason the customer is the most important out of all these six is because the customer is the only constituent in this business model that pays. All the others take. And it was fun. It was fun to do. I've been in Australia a number of times looking at some businesses down there. Yeah, it was a fantastic job. And so what led me to where I am today in terms of writing this book is that many years ago, even before I became an investor, I had decided that I was going to do everything possible to not be a burden on anybody else. And so whatever I have from a material wealth perspective, I would hope would be a reflection of the wealth that somebody else out there also has. And in a free market capitalist system, that's the way it's supposed to work. You only benefit if you've created capital that somebody else values and they're willing to, without coercion, freely exchange their capital for your capital. And we do it through the medium of exchange called money, which we'll talk about, I'm sure. And so when that's happening, it's a beautiful thing. Increasingly, that's not happening. People are benefiting at the expense of somebody else. And I talk about this, but it's often 2 or 3 steps removed. You can't see the perpetrator. You know you're getting screwed and life's getting more difficult, but you can't see who it is benefiting directly from your stress. And so I talk about it in the book. It's getting like a big game of poker. So in a game of poker, there's no capital created at the table. There is a redistribution of wealth at the table. And at the end of the game, you have one winner and a bunch of losers, which, is sounding increasingly familiar to a lot of people out there. And it's because I believe the monetary system not only enables it, but encourages it. And it's not a conspiracy theory. I don't believe that policymakers purposely set out to increase wealth disparity, which is what has happened, and it was entirely predictable, by the way. They convinced themselves that by bailing out Wall Street, by creating a housing wealth effect after the '01 recession, that by driving asset prices higher, yes, the existing asset owners would benefit. But don't worry, the benefits of that will all trickle down to everybody else because those higher asset prices are going to drag the economy up with them. No, it doesn't work that way. So if you back up, so for stock markets, if stock markets are going higher because companies that are in the index are putting capital, putting scarce resources to productive use to create more capital, they increase their profit, they hire more people, they pay them more, they reinvest in the business, ratchets up that higher profitability, then pushes their share price higher. And then if all the companies in the index, or most of them, are doing that, then the stock market grows higher. So that's a real wealth effect. People feel wealthier because they truly are, not only are they wealthier, but society as a whole is wealthier because there's more capital than there was before. That's a really good wealth effect. But if stock markets are going higher because the Fed is taking interest rates down to zero or resuming QE, printing money to buy assets and drive equities higher through the portfolio effect, which we can talk about, then no real wealth is being created. Wealth is being redistributed within the system. The asset owners are receiving more for the capital that they own. It's not that more capital is being produced. And we can go into exactly how that works if you're interested. So we've had a fake wealth effect. It doesn't mean that there's no wealth being created. It's just those who own stocks are much wealthier than they would have been otherwise if the Fed hadn't imposed its will on stock markets and deliberately, and this is the problem, right? The markets know that the Fed will not let the stock market fall.
Mm.
They'll come to the rescue. So it encourages reckless behavior. It encourages mass speculation. Take on as much leverage as you can because the Fed is going to be there and they got your back. But this is extremely harmful for the economy. The price discovery mechanism of capital markets, market players with skin in the game who know there's a real chance of loss, so they're very careful with how they allocate their hard-earned capital. And it results in the most efficient allocation of capital. It results in the best productivity growth. What we've had over the last 25 years is declining productivity growth, still growing, but not nearly as fast as it used to. And you've got zombie companies roaming the earth, who are destroying capital. Back in the early 80s, according to the BIS, or Bank for International Settlements, zombie companies back in the 80s were like low single-digit percentage of listed companies in developed economies, maybe 2-3%. Before pre-COVID, I think they got up to 17%. So these are companies that through Schumpeter's creative destruction should have gone away a long time ago, and that capital, those resources, should have been reallocated within the economy and put to more productive use. Instead, they're allowed to exist and consume capital rather than create it. So that's on the stock side. Even worse, well, I don't know if it's worse. Well, it's worse for young people, is attempting to create a wealth effect through the housing. Yeah, so we were talking about the housing effect, or the wealth effect through housing. So even worse than a fake wealth effect by artificially driving stock markets higher by distorting the price discovery mechanism of capital markets and distorting the most important price in the economy, which I think Jim Grant talks about this, is interest rates, the most important price. And it has been completely hampered by central banks and is not allowed to fulfill its really important role of helping to allocate things and direct things within the economy. We have a distorted signal now. But even worse than this is driving housing prices higher in order to create a wealth effect. Now, the Fed will never explicitly say, although their actions and many things they've said, it's pretty clear this is what they were doing, in my opinion. So after, you remember the dot-com technology boom in the 1990s, the whole rational exuberance thing that Greenspan called it, and then he thought it was okay because productivity was justifying higher market prices or stock prices. So it was creating a very positive wealth effect as stock markets were soaring. People were feeling wealthier because they were wealthier. So they would either sell their stocks and spend it or borrow on their portfolio, spend that. That was contributing to GDP. GDP is just final spending. And by the way, we could talk about why that, I believe, is a very misleading a misguided measure of economic health. So then it all came crashing down. And then there was a negative wealth effect. People were feeling less wealthy, so they started spending less money, which is not good for that GDP number. And so back in 2001, Paul McCulley of PIMCO and Paul Krugman echoed that the Fed should create a new wealth effect through the housing market because a lot more people own houses than stocks. And so if you can drive housing prices higher, that will encourage even more people to spend, and that will be good for the economy. Again, this is the Keynesian sort of mindset that consumption is the fount of all economic prosperity. No, that is the result. What drives an economy forward is saving and investment. That allows us then to consume. So they got it all ass backwards. And they think that because they look at GDP final spending and 2/3 of it is consumption. And your consumption is somebody else's income. But you cannot consume, like Jean-Baptiste Say said, what you produce gives you the wherewithal to then go and demand something. I'm getting off track. Anyways, back to housing. We could talk about that. So they take interest rates down to 1%. I think this was in 2002 or 2003. despite the fact that the economy was growing. The recession in the US in 2001 was very mild. It wasn't even 2 consecutive quarters of contraction. It was only 1 quarter. And so in '03, the economy is growing, presumed. They keep interest rates at what would have been normally being considered emergency levels. We must be at war, or there must be something going on, a plague or something. No, they kept it down to drive housing prices higher. And they kept it at extremely low levels for about 3 years. And of course, the housing market responded. And you had that crazy wacko housing market in the 2000s, which resulted in the subprime mortgage debacle and the greatest financial crisis since the 1930s. And so rather than say to themselves, well, you know what, maybe we shouldn't have done that. Instead, they doubled and tripled down with QE, printing trillions of dollars, buying trillions of dollars of mortgage-backed securities to drive mortgage rates to the floor to try and get housing prices back up. Now, with QE1, I still don't think it was justified. I think Wall Street presented politicians with a false dichotomy. They said, you can bail us out. I know that's distasteful. Or your only other alternative is global financial Armageddon. So I think there were lots of things in between there. But of course, they wouldn't have been very much fun for the banking community. I think any banks that were insolvent should have been nationalized, not let go. They don't go bankrupt. Government takes them over, shareholders wiped out, bondholders, maybe you're getting 25 cents on the dollar, something like that. But the banks are still running. ATMs are still running. You fire the board, you fire the senior management, middle management is still there running the business. And then you break the banks up back to the old Glass-Steagall thing from the 1930s, and separating commercial and investment banking. And so you make the banks smaller, and so none of them are able ever again to hold the rest of the world hostage. But anyways, back to the housing wealth effect. A house has no business going up in price. Now, there are going to be some instances in areas, very popular areas like New York City or London or wherever, they're always going to be more expensive. But like I was saying earlier, in a free market capitalist system, you're only supposed to be benefiting to the extent that you're benefiting somebody else. So you create capital, they create capital, you fairly exchange it. So my wife and I live in this house. It's in a suburb of Toronto. And we bought it in 2001. It just happened to coincide with when the Fed started their housing wealth effect policy. And so our house has gone up 4 times in value over the last 24 years. So if we're only supposed to be benefiting because somebody else is benefiting, and we make 4 times on our home, who else out there made 4 times what we made on our home? Nobody. But it's worse than that. It's not that somebody else didn't make 4 times. It comes at their expense, 4 times their expense. So a house is not a productive asset. Our house is not producing 4 times the amount of stuff that it produced in 2001. It hasn't increased 4 times in size. It hasn't relocated to where you live, the beautiful area part of Australia. It's the same economic good that a younger couple or a newcomer immigrant to our country is forced to pay 4 times what we paid for it. So it's a redistribution of wealth from their bank account and into our bank account. And you're at the point, so it's completely unfair. I think it's immoral. I don't think like I said before, I don't think policymakers really thought it through. I don't think they thought that these actions would lead to a housing affordability crisis where a whole generation is priced out of the market, where I think the average first-time home buyer in the States, the average age is 40 years old now. I mean, this is utterly ridiculous.
Like that in Australia.
Yeah,
Yep.
yeah, I mean, and Australia and Canada, probably the two worst housing markets from an affordability perspective. So nobody intended to get us to this place, although it was very predictable. And so here we are, where a whole generation, they're pissed, and they should be, right? They've played by the rules. They've gone to school. They're better educated than me. They're willing to work just as hard, just as smarter, probably. Yet they can't even dream of affording the sort of lifestyle that I have been fortunate enough to enjoy. Now, don't get me wrong, I worked very hard, but so are they. And so it's like the contract has been sort of ripped up and thrown out the window. Now, I'm 64, and, I haven't done anything wrong. And when I tell this to, my friends, my family, my generation, like, no one is to blame. This is not about I'm not trying to be sort of vindictive here. It's like we all play by the rules. And you thought, well, yeah, just get on a housing ladder, as they call it, and then you'll be able to sell that house and get a bigger one, and that will go up in price, and then you can retire in comfort. So, it's not about bad people. It's just about a bad system. And so when I tell people my age this story, at first they don't like it, and I get it, right? Because it's human nature. You like to, made 4 times on your house, Musson. Way to go. And say, yeah, I know a thing about real estate. I knew what I was doing. No, I didn't. We just needed a place to live. And we happened to buy it just when the Fed started their housing wealth effect policy back in 2001. I just got lucky. That's it. Right? Doesn't mean I didn't work hard. Or same thing with all my friends and family. They all worked hard, went to school, saved, and they made a fortune on their home. And so when I explain this to them, at first they don't really like it, or they they look surprised. But then they very quickly get it, and the vast majority say, "You're right. It's not fair." Although every now and then I do run into someone, not very many, but every now and then I run into someone who not only doesn't like it, but refuses to acknowledge it, refuses to acknowledge that we have unfairly benefited at the expense of the next generation. And they'll come up with all kinds of crazy theories as to what's going on, which are all very easy to debunk, obviously. But I get it, and they're not bad people, don't get me wrong. They're not bad people. But it's tough when you've lived your whole life believing something, and then you're told by me, Mr. Debbie Downer, that, maybe we didn't deserve this, and it's I'm always reminded of that saying by Upton Sinclair. He was a U.S. I think he was a politician, like a left-leaning socialist politician back in the 1930s. And he said that if somebody's income depends on them not understanding something, then don't expect them to understand it. It's not that they can't, they don't want to. Emotionally, they can't. Intellectually, they can for sure, but they don't want to. It's too painful.
Yep.
And I totally understand it. And so over the years, as I was investing, I said earlier, we looking for like world-class businesses. So we would take the savings, the hard-earned capital of Canadians, and they had already saved and they're doing well. And we would take their capital and try and augment that for them. Just grow a little bit, protect it at the same time. And we would affect that by investing in world-class businesses who we were confident would put their capital to productive use and grow it carefully. And then that comes back to the clients, and they're better off, and they pay us and they pay their advisor, and And everybody wins because everybody's providing a service. Like, I don't create capital, I play like a facilitator role, which we could talk about how government and finance industry are facilitators of capital creation. You don't create capital. And so I always felt that I was playing an important role. Myself and thousands of other investors, this is the role that we play, channeling savings to productive use and keeping companies honest. And if they're not putting the capital to productive use or doing stupid things or making reckless acquisitions because their organic growth is slowing, and then we take the capital back. You starve basket case companies of capital. But then the housing effect, then the bailouts of Wall Street, and I just became increasingly frustrated that this was happening. And you could see the path that we were on and how this could potentially end. And it will not end well. That I know for sure is not sustainable. Exactly what that ending looks like, I don't know for sure. I've got some things, and we can discuss one or two things. And I don't know when. Nobody does. And I've been talking about this with my clients who are financial advisors, so stockbrokers, financial planners, like amazing people, for many, many years. And a number of people over the years said, Paul, you should really write a book about this. You're the only one that talks about it in this way, at least in the mutual fund industry that they knew of. And I think one of the reasons they recommended that I write a book is because of my presentation style. So back when I first started off in the investment industry, you go to a conference and you get up on stage and you got hundreds of financial advisors out in the audience there, and you're nervous as hell because a lot of smart people in the audience. And so my goal was to impress them, try and impress them with how smart I was. So I used all kinds of charts, graphs, and fancy words, and I started getting caught out in little white lies over the years, or contradicting myself, because I was saying things to get the sale, to get their money, rather than being intellectually honest and thinking about how best can I help them with their business? How can I help them explain to their clients why they're investing their money with us or why they're not investing their money with us? And so, it was getting embarrassing getting caught out like that. So I just said, that is it. I'm not doing this anymore. I am just going to tell everybody the unvarnished truth, whether or not I think it's going to lead to a sale. Like, I never lied, but I would tell people what they want. I knew what they wanted to hear.
Yeah.
And so then I just started to think, how can I most clearly communicate what we do and why, what's going on in the economy, and empower them to make the right decision with their clients' hard-earned capital. And it might mean that they don't invest with us, but that's a good outcome then, because we're not appropriate for them. They have a different risk tolerance or whatever. They won't stay the course. They'll get pissed off because we're not keeping pace in a crazy market. And so intellectual honesty and clear communication became an extremely important part of what I was doing. And it was fun. And the more I did it, the more I enjoyed it. And so my book, Capital Offense, Why Some Benefit at Your Expense, is written in very easy to understand terms. And so if somebody reads it, takes the time to read it, they will understand what's going on. I use all kinds of analogies, stories and stuff like that to sort of bring home the point. And the reason it's called Capital Offense, it's a very, title, very provocative title, I guess. Yeah, to say the least. But the reason it's called that is so people need to understand the difference between capital and money. So money is extremely important, but it's not money that makes the world go round. It's the creation of capital. So money is simply the medium of exchange, what we use to exchange all that capital indirectly. And we temporarily store up our capital in that money. So the example I like to give is, let's say you make a bike and I make a suit. So we both create a capital. There was no bike in the economy. There was no suit. You made a bike, I made a suit. And then we exchanged the bike and the suit with each other. So that's barter, direct exchange. And now I've got your bike, you got my suit. This creation of capital and the exchange didn't come at anybody else's expense. Nobody else is worse off because of what you and I just did. That's the way it's supposed to work. Now, we don't do direct exchange. You could not have an economy of any size if you were just doing barter. The example I use in my book, well, how many kitchen chairs do I have to make to buy a flight to Florida? Or what about, someone who sells filters for a furnace? What if they need brain surgery? So it doesn't work. So we have money. So now let's say you make 10 bikes, they're $1,000 each, they're nice bikes. You sell them. So you've got $10,000 in your bank account. What that $10,000 effectively represents is the 10 bikes that you made. You're effectively storing up 10 bikes in your money while you're waiting to use it, while you're waiting to spend it. So you don't want to spend your $10,000 right away. You're saving it to go on a vacation at the end of the year. Now, before you get a chance to spend your money, the central bank doubles the money supply. Now, when the central bank increases the money supply, they do not create any capital to access that money. They just create that money out of thin air. Print it or press a few buttons, it's digitally created. And so that new money has no capital stored up in it, but it obtains capital as soon as it comes into circulation. It obtains capital from the rest of the money that's already in existence. So as soon as the Fed doubles the money supply and that money comes into the economy, it takes 5 bikes from your $10,000 and puts it into the newly printed money. So now your bank account statement still says that you've got $10,000 in your account. But instead of storing 10 bikes, it's only storing 5. And so now your $10,000 will only buy half as much as it would have done before the Fed doubled the money supply. And that's why my book is called Capital Offense, because they take your capital from your money without your permission. And doesn't produce, government's very important. I'm not anti-government, and I'm not anti-welfare state either. I'm very much in favor of it. I'm not in favor of too much. If the benefits are too generous, it's a disincentive to work. And the only way you can pay those is by taxing people more. And the more you tax them, they're disincentivized to work as well. So both sides are disincentivized to work. And you get less and less stuff being produced than there otherwise would have been. So the government doesn't produce anything itself. Anything that it spends, it first obtains from the private sector. And it can obtain capital from the private sector only in one of 3 ways. Most obvious is taxation. And that is something that they can campaign on, and we can all vote accordingly, deciding on what we think is a fair amount of capital to be taxed away from us to help those who are less fortunate, to help pay for Medicare, to help pay for welfare, defense, whatever, police. So taxation. Second way governments can obtain capital, obviously, is by borrowing it. So we freely lend our money, capital, to the government, and then we expect to be paid back, and we can talk about that. When you have a government bond, it's an asset but it's not an investment. The government does not invest your capital, it's consumed. We'll talk about that later. And then the third way that the government accesses capital is by printing money, by extracting capital from the rest of the money that's already in existence. And anyway, so I've gone on for a bit. Maybe I'll stop there and see where you want to go next.
Need a way to sign, verify and secure your Bitcoin? Australia's one-stop shop for Bitcoiners has you covered. From signing devices, nodes and backup solutions to BitAxes, Daycall and apparel. Visit shopbitcoin.com.au.
Yeah, there's a lot that I want to cover, but I guess the first question I have that I'm most curious. So obviously you said, you're a voracious reader and you've always had education that you've done on the side in conjunction with your schooling. I'm very curious to know that when you entered traditional finance, were you immediately aware of this problem, or is that something that came later on?
Yeah, I had no idea. No idea. And I would say it was only around 2003, 2004, that where the housing wealth effect was starting. And it was like mind-boggling what was happening. Like these negative amortization mortgages. So central bank and the financial community were doing everything they could to increase demand for housing. So first by driving interest rates down to 1 or extremely low levels. And then with new mortgage structures. So first they started offering interest-only mortgages. So your monthly mortgage payment, you're only paying the interest. You're not paying any of the principal down. Of course, that lowers your monthly mortgage payment and enables you then to buy more house or bid more on a house and drive the house price higher. Then they started doing negative amortization mortgages. So they would, let's say it was a 6% mortgage. For the first 3 years, let's say, it would start off with a teaser rate of 2 or 3%. So you're not even paying the full interest expense on your mortgage. You're only paying 2 or 3%. The other 3% would be added to your mortgage. So each year, your mortgage, despite the fact you're making monthly mortgage payments, your mortgage was getting bigger and bigger. But of course, people who were doing this were told by the banking community, well, don't worry, because house prices are going up 20% per year. And especially in Florida, they're not building any more oceanfront and all this nonsense. And so, after 3 years, when it's triggered, when you have to start paying your principal down and you're not able to afford it, well, you just refinance because your house has gone up 30% in value. And then you start the whole thing all over again. Well, that worked until house prices stopped going up and started going down. And then I think you had about 25% of mortgages in the US by 2009 that were in a negative equity position. So they owed more to the bank than the house was worth. So back in 04, 05, 06, when this was starting to happen, I said, this is insane. You're getting people into houses that they can't afford. And a lot of people suffered enormously. I didn't know it was going to end up being the great financial crisis. But I knew it was stupid. And I knew it was irresponsible. And I knew it was reckless. And I knew why it was happening. And I think that was the start. That combined with long before that, I had my blog, which you mentioned, is called Political Economy. It's a free weekly blog, by the way. Anyone can sign up. At the end, I do an audio version as well. At the end of every post, I sign off with, be free and do no harm. I don't want to prescribe all the great things people should be doing. It's none of my business. But I think, if you're free and you really focus on trying not to do any harm, either physically, financially, emotionally, just by focusing on that, it's really hard not to make the world a better place, Follow your dreams, just make sure that it's not coming at anybody else's expense. And then you can do all the other stuff as well, help people out when they need it and all that kind of stuff. I'm not saying you shouldn't do that. And yeah, so I think that's my initial foundations, if you will, and then seeing what was going on, and then it sort of woke me up, if you will. And then I've been on a journey ever since. So really starting in '07 is when I started reading economic philosophy. And I didn't really know anything about economics. And so I didn't have any preconceived ideology, if you will, apart from the do no harm. And so then I definitely leaned towards the Austrian school of economics. I liked classical school. So actually, one of your guys, Stephen Cates, is an economist. He's actually a former Canadian. He's an economist. He lives in Australia. And he wrote a book about Say's Law. He's written a few books. He's a great writer. I've had a few email exchanges with him years ago. But I learned so much from him. And then the economist I learned the most from was just on your show a few weeks ago, Bob Murphy.
Yeah.
He's so good. And George Selgin, I don't know if you've ever heard of him. He's a free banking.
No, I haven't heard of George. No.
Yeah, he's amazing. He's so those three guys. But I was reading going all the way back, just trying to again create a foundation, if you will, of like a philosophy. Like, what are the different schools of thought, and why do they exist? And you would think that economic laws are what they are, and they are. But there's different schools of economic thoughts because economics is a social science. It's not a hard science like chemistry or physics. It's based on human action, as Bob talked about when he was on your show. And so, the laws of economics can be very inconvenient and can, dictate that government should not run deficits. They should not run up the debt tab because it's not good for the economy. In emergencies, there's nothing wrong with that. But post the emergency, you should pay it off. And so then people, I think it's called normative economics. So economic schools of thought based on ideology, based on how you would like the laws to be rather than how they are. And then you come up with complicated formulas and stuff like that, and consequences 2 or 3 steps removed from the action, so it's hard to connect the dots. And I think Bob used the example on your show. He's used it many times. It's like getting angry or blaming gravity for plane crashes. Stupid gravity. Well, no. Gravity is what it is. You can't change it. So don't try and come up with a new law which will get rid of gravity. It's not going to happen. Or blaming gravity for, unfairly targeting visible minorities. No, people do that. Economic laws don't do that. And so one of my main goals with the book, because I have great faith in people. And I think the average person is very smart, particularly when it comes to what they should be doing with their own hard-earned capital. They don't need a policymaker to tell them that stocks are fairly valued, so you should be buying them. You should be buying this house because the price is going to go up again and you're going to make a fortune. No, shut up. It's none of your business. You should not be trying to coerce people or encourage people into spending their money in areas that you think they should be. That makes me so angry. And so the average person is very smart. And I think the average person as well is a very good person. Most people want to do good things. And I believe that one of the main issues, the reason that we've gotten to where we are today, is because people don't really understand what's happening. They don't understand why they're making a fortune on their home. And there's an old saying that the people always get the government that they deserve. In other words, well, you voted for them, so shut up and stop complaining. Well, no. You only get the government you deserve, A, if the government does what they said they were going to do, but also if you actually understand what's going on. You can't vote accordingly if you don't know what's going on. And so my goal with the book is to help people understand what's going on, is to educate all these beautiful, well-meaning, very smart people with respect to how their capital is being taken from them and redistributed, all with good intentions, by the way, and then demand different actions from our policymakers. And our policymakers will do it because they're not bad people. They want to do the right thing. But doing the right thing today is political suicide because they and the academics have convinced us all that you can get something for nothing. The deficits and debts don't matter. They do. They matter a lot. And so if a politician tries to do the right thing by being responsible and stop redistributing other people's wealth from the next generation to our generation, well, guess what? They're not going to be in office very long. And so they're not going to remain in power to do all the right but difficult things. They'll do it once we demand it.
Yeah. On that, I'm very curious to know, because the way I kind of understand the system is it's set up in a way that the governments and the policymakers of the day kind of have no option but to kick the can down the road as far as they can. If we were to demand change, what might actually some of the solutions be? Can we reform the system that is so badly designed?
Absolutely we can. The only trouble is that it won't be without pain. And it won't be easy. Some people will benefit enormously from that change. Next generation. My generation will be harmed. And, like I mentioned, our house has gone up and it's worse than you think, Anja. So by encouraging people to rely on the inflated value of their home for their retirement, it encouraged people to spend and consume more of their capital than they otherwise would have done. So society saved less. So the time preference in economics, they call it, the time preference of society is higher than it would have been otherwise. So time preference I like to make sure people all understand it. Time preference is just your desire to consume today rather than delay your consumption and consume in the future. So if you have a high time preference, you typically save a lot less or nothing, and you consume it all today. If you got a low time preference, then you consume less today, you save more of your money, you invest it, and you can consume that much more in the future. So you delay your gratification for your own consumption. So encouraging people to rely on their homes for their retirement encouraged people to save less. So there was less saving and investment in the economy than there otherwise would have been, which I think has contributed to declining productivity growth. So that's the first thing. So when people, when you pay off your home, the way your home should provide you with a nest egg for your retirement is because you paid off your mortgage over the years. And it's a really cool thing. Like a mortgage, it's a form of forced savings. So you have to pay the bank the monthly mortgage, otherwise you might lose your home. And so every time you make a monthly payment on your house, on your mortgage, it's like a piggy bank. You're putting some money into your home. So if you make bikes, you sell a bike and you got money, your bike is stored up in that money. Now you use that money to pay off some of the mortgage. So effectively what you're doing is you're storing your bikes in your house. So after 25 years or whatever, you've paid off your mortgage, you own your house free and clear. Let's say it's worth $400,000. Effectively, what that is what it represents is the $400,000 worth of bikes that you created through your career and exchange with other people, right? So that now you retire and you've got $400,000 worth of bikes stored up in your house that you can now fund your retirement with. But in places like Canada and Australia, your $400,000 home is probably worth 1.6 million. So not only is it storing $400,000 worth of bikes, but it might be storing $400,000 worth of nursing services from a younger couple, or electrician services, or suits from new immigrants they want to buy a home now. So you've got all this other capital from all other people stored up in your home that you can now go and spend. But that's capital that they cannot spend. So we can reform the system. At first, at the end of the book, I've got sort of the 10 steps. It just happened to be 10. I hate it when people have an even number. It looks like they started, I need 10, and then they sort of reverse engineered it. It just happened to be 10. But the first one I should have put was what I just said, that step 1 is educating people with respect to what's happening. But step 2 would be to stop increasing the money supply at such a rapid rate. Now, I know you've had a lot of Bitcoin people on, and I totally understand where they're coming from. I get it. I understand the principle of why Bitcoin. I don't know that we have to go to Bitcoin. Maybe we do. I don't know. But there's nothing wrong with a fiat currency system per se, other than it's subject to terrible abuse by, well, no, exactly. So, I don't know if you've ever read any of Lawrence White's work. He's got a good book published last year, I think it's Gold, Dollar, or Bitcoin, and it's well worth reading. And so, gold standard, I think that's what he leans towards, a slightly elastic money supply. I don't think he wants a completely inelastic money supply like Bitcoin. But then he talks about Bitcoin as well. But I don't think you need to go to gold. Like if the authorities could be trusted with a fiat currency system, because I think it's a lot more efficient, obviously, a lot less costly than going around the world and digging up gold and transporting it all over the place. But that's the issue. Like, can they be trusted? And, whenever there's an emergency and they decide what defines an emergency, they'll simply break the rule and start printing again. And they'll, like during a great financial crisis, their favorite saying, well, this is no time to worry about moral hazard. Yes, it is. That's exactly the time that you should be worrying most about moral hazard. And they'll do that because they're able to convince people and themselves that it's for everybody's own good. So it's only with an understanding that it's not will they potentially not do that. It just understanding, empathy, we need all this compassion. It's not going to be easy. So understanding, stop increasing the money supply. I think Milton Friedman used to talk about increasing the money supply at a preordained rate, if you will, like 3%, 3 to 5% or something like that. That'd be a lot better than what we've been experiencing over the last decades. The next step is to stop interfering and distorting interest rates. As James Grant says, the most important price in the economy. That would lead to significantly better allocation of capital and productivity growth. And then no more bailouts. Wall Street needs to know, and investors need to know, that if they screw up, taxpayers are not coming to their rescue either with fiscal stimulus or by the Fed printing money and extracting capital from the savings of all the taxpayers. And that alone would have such a positive impact on the economy. Eventually, initially, it'd be very painful because asset prices are going to fall to their intrinsic value, both housing and stocks. And by no means should authorities try and force prices down. But if you stop manipulating interest rates and printing money, and Wall Street knows that the Fed's no longer coming to their rescue, then prices will adjust all on their own. And so it will be painful for some. And I understand that. And it's terrible. It's terrible. But this is not about punishing people. Some economists out there, they think that, for people like me who claim that a recession is necessary once an economy has been distorted higher by central bank policy, a recession is necessary to cleanse the economy, to fix the economy, to heal the economy. It's not about punishing people. So, and I use this example in my book, if you have a tumor and you go to the doctor and the doctor says, okay, it's serious business here. I can operate and I can save you. But it's going to be 18 months of rehab. You're not going to be able to work. And so from an economic perspective, it's going to be very tough for you. It's going to be a pretty bad recession in your household. And guess what? There's going to be contagion. Your household, your family members, due to no fault of their own, are going to suffer as well. Everyone's going to have to tighten their belt here. But after 18 months, you'll be healed, and then you can go back out. It's not up to me, the doctor, to tell you whether you should work or not, how much you should earn, how much you spend. No, I just focus on your health. So as the doctor, am I punishing that person by trying to heal them? No, And so doctors don't take that route because they don't want you to be out of work for 18 months. So instead, they print money to drive the asset prices higher right away and paper over the tumor. Instead of taking the tumor out, they give you this stimulant and whatnot, and you feel better, you go back to work the next day. But 18 months later or 9 months later, you come back to the doctor, you still don't feel too good. Well, guess what? The tumor is not only still there, but it's bigger. Now, I can still operate and save you, but instead of 18 months of rehab, now it's 3 years. And so the consequences of now doing the right thing are that much more severe, which makes it that much more difficult to do the right thing, right? Because you're going to get blamed for the suffering that everybody's going through, which are the consequences of bad policy from so many years in the past. And so for people who bought, like people like me, so if my house went down, the highest price got cut in half. Yeah, that's a big blow to my household wealth. But I didn't earn it. It should never have been mine in the first place. And so with that sort of mindset, it's easier for me to say, well, I would accept, well, I wouldn't have any choice, but I would actually celebrate that happening because it means that the next generation now is going to be able to afford what I was able to afford. Like it's a more fair and moral way of being, if you will. Now, it's very easy for me to say that, but it's not as easy for, let's say, a younger couple who recently bought a home at a very inflated price. And for them, it would be particularly painful. And that's not good. But it doesn't mean that you should continue to price a whole generation out of the housing market behind them just to maintain the value of these people's homes. But for people like me who still have a capital gain on the price of their home, that when you sell your home, some of that, there could be some form of capital gains tax to help those younger people who bought right at the top due to no fault of their own, and now they're down 30% and they have to move and they're 30% underwater on their mortgage. That's not their fault. So those who benefited, I think, should be willing to help. In the States, you have capital gains on your home, right? So I think for an individual, if you make money on your home, the first $250,000 gain is tax-free essentially. And for a couple, you can claim up to $500,000. But above that, you're getting taxed at the capital gains rate. And I don't think there's a capital gain on your principal residence anyways in Australia, and there's not in Canada. So people can make millions on their homes up here. And again, they haven't done anything wrong, but if it's come at somebody else's expense, I think a lot of people would be willing to, okay, so maybe it's, like maybe in the States, maybe after $250,000 of gains or $500,000 of gains that you start to get taxed at the capital gains rate or something like that. I don't know. There are probably a number of different solutions. But I think if we all approach it in the spirit of fairness, of understanding and compassion, and not trying to demonize anybody, then I think we can come up with some solutions that would result in the least amount of pain for the least amount of people. I think. Absolutely. Yeah. Yeah. No, absolutely. You're absolutely right. And so somebody's getting screwed here. That is a given. That is unavoidable. And so I think you want to have the least amount of people being screwed by the least amount, if you will. And yeah, it won't be easy. Yeah. But I think, as I said before, understanding, compassion, fairness, but it's amazing what people can do if they put their heads to it and they really want to make a difference and they really want to make it fair and least painful. But it's also amazing what people can do when they want to convince themselves that they are justified in making 4 times in their home. It's amazing what Wall Street can do to justify why the Fed needs to bail them out. They won't consider anything else, right? They will just consider, they will counter any other potential solution other than bailout, because any other potential solution is not going to be very good for them. And so there are no easy answers here at all. I'm not here to tell people that there are. I wish there were. But, particularly in the US and increasingly in Canada, I'm not sure what it's like in Australia, but society is getting divided, and it is so sad to see. And I think this is a huge part of it. Younger people in particular, they understand that they're not getting a fair shake for the most part. They understand that it's not fair, but they don't understand why. That's why I wrote my book. Yeah. And so if you don't understand why, but you understand you are getting screwed, then it's very natural to look for someone to blame And so it's very natural then for Republicans to blame Democrats and Democrats to blame Republicans. Up here in Canada, it's conservatives blaming liberals and liberals blaming conservatives, right? And that's almost all you got. And now people can't even talk to each other. My mom and our eldest daughter live down in Florida. And so we go down there a lot. And we've got a lot of friends down there, Democrats and Republicans. They're all beautiful people. Many of them can't talk to each other, and they agree on 95% of the stuff, and even the 5% which they differ, I mean, they don't really differ a lot, but they're told to hate the other side. And it's getting worse because the root cause of it, in my opinion, is not going away. And so, yeah, we can decide to, and it's not sustainable. So it's not sustainable. And so one way or another is going to end, in my opinion. Now, it might end next week. It might not end for another 10 years. There's this rule, the rule of holes. The rule of holes is when you find yourself in a hole, the first rule is to stop digging. And instead, we've been digging faster and faster, such that, the bailouts are that much bigger. Government gets even more involved in the economy. The central bank balance sheet goes even higher. And yeah, so it will end, and it will either be, in my opinion, an out of control explosion where the people, those who are getting screwed, finally have the vote. And they say, well, no more of this. And you get some sort of hardcore socialism. You're getting more and more movements. And it's natural that socialists are pissed off. They should be. But they don't understand what's going on. So they would throw out the free market capitalist baby with the crony capitalism bathwater, with the crony capitalism moral hazard bailout Wall Street bathwater. And then you think things are bad now. Things would be, it'd be a lot more fair, but instead of the wealth disparity be here, which is ridiculous, there should be wealth disparity based on contributions, ability, whatever. Should be here, we're here, which is crazy. With socialism, it would be much more even, but we'd all be way down here, And so that's the out of control explosion, or we have a controlled implosion, like what I've talked about earlier. And listen, I wish there were other choices, and maybe there are. I just don't know them, and I'd be more than happy to to listen to what other people have to say. But I don't see it. But yeah, exactly, and it is complicated, and the terms that are used are in some ways deliberately made to confuse. And but like as you just said, it's because of a lack of understanding, which is precisely why I've written the book. That is step one. And it is my hope that, well, first of all, it gets read, and that, hopefully it can make a difference and start a movement where, there are so many incredibly talented, capable people in this world. And if you can get them on board, I think we can get there. I do. Like, I'm an optimist. I'm a realist, first and foremost. I am. But I'm also an optimist in that, yeah, I really do believe in people. And for the most part, people want to do the right thing. They just don't know what to do. Right? And they don't know that they're doing the wrong thing. And, it's bad systems bring out the worst in very good people. And vice versa. And vice versa. And I think with a better system, a fairer system, a more honest system, a more honest money that, that could really bring out the best in so many people, create that many more opportunities for that many more people. So many people don't have a fair shake at the stick. They don't have a fair chance. And just imagine if that many more people were able to productively contribute to society, we'd all be that much better off. I mean, never mind, first and foremost, from a moral perspective, giving people the opportunity to live a fulfilling life and a productive life, we'd also all benefit from it. It really is a win-win situation in my mind. And yeah, so that's my hope. Maybe it's a dream. I don't know. Guess I would, try not to. A lot of people are very angry, understand, but try not to get angry at, your fellow citizens. Try to have more empathy from, try to see things from their perspective. And I think with more understanding and more education about what's going on, I think more people will be on board and want to help each other. I really do believe that. But people are going to need to see evidence. And I get that too. And I think that, once we all decide to do the right thing, like, we'll do it. But it's important that people know and trust that we are all in this together, and it's not just me that's going to suffer, and they're all going to be fine, and I think that will happen. If we don't, we're going to end up in something like the movie from the Hunger Games, where I don't know if you saw that movie, but you know, well, yeah, and whether it's in the form of gated communities or whatever, I mean and less stuff being produced and people worse and worse off. But I just think have faith in people and let's move forward. Well, thank you, Anja. It's been great.
That's it for this week on The Honest Money Show. A big shout out again to shopbitcoin.com.au for making this episode possible. Until next week, stay smart with your money and stay decentralized.